a brief history. Today, it is very easy for anybody to speculate in the FX markets, but it wasn't always like this. In the past, currency exchanges were, for the most part, fairly stable. While different currencies and the need to exchange them has been around since the Babylonians, who were credited with the first use of paper notes and receipts, exchange rates as a whole were relatively stable. Speculation pretty much did not happen, and certainly the huge speculative activity in the market today would have been seriously frowned upon. Most banking and government institutions, as well as the general public, regarded speculating in currencies as a negative thing and preferred the exchange rate stability. Prior to around the 1970s, currency trading was limited mostly to large companies who were conducting business in multiple countries. Trading for investment and speculative purposes was generally not done at this time, well, not by retail traders anyway, and for many reasons, lack of volatility and trading accessibility being two of the bigger ones. Towards the end of World War II, many economies through Europe were in serious trouble, whereas the US, being far away from the chaos and destruction, was viewed as a strong economy with a large, powerful military, and also a large supply of the world's gold. In July 1944, delegates from 44 countries met at the UN Monetary and Financial Conference in Bretton Woods, in the US, to establish what was called the Bretton Woods Agreement, the monetary and exchange rate management, to help these struggling economies recover and stabilize. The Bretton Woods Agreement had various aspects to it, but it was the pegging of foreign currencies to the US dollar and then the US pegging their currency to the gold at $35 per ounce that had the greatest immediate impact on the global economies. At this time, the US owned about 2/3 of the world's known gold supply. The US government was obligated to maintain gold reserves equal to the amount of currency in circulation. In other words, the US dollar was backed by a real asset, gold, and was declared the world reserve currency. By pegging or linking these currencies directly to the US dollar, the value of the pegged currencies remained dependent on the value of the US dollar. This worked fine for many years, but eventually ran into a few major problems. The most obvious being that for many reasons, some good and some perhaps not, the US printed more and more US dollars. So while the gold supply remained stagnant, the supply of US dollars was steadily increasing, and as with most things when the supply increases, the perceived value tends to go down. At this time, many other countries were becoming concerned and losing their trust in the US dollar, because they knew the US could no longer back up their currency by gold. There was simply not enough gold compared with the US dollars being printed. So these countries started exchanging their currency for US dollars and then exchanging their US dollars for gold, because gold was still an asset with real intrinsic value, with a finite supply. When you think about this, it was a pretty good speculative trade. The US dollar was devaluing itself, but at the same time had promised it would allow foreign countries to exchange US dollars for gold at the rate of $35 per ounce. Eventually this came to an end, as the US gold reserves were getting seriously depleted. So in 1971, President Richard Nixon put an end to it and announced to the world that the US would no longer exchange gold for the US dollar. This meant the US dollar became once again a fiat currency, not backed by any real asset, just a promise from the government like most other currencies today. This point effectively marked the end of the Bretton Woods Agreement, and most countries went back to the use of individual floating foreign exchange rates. And because they were no longer tied to each other or to gold, the volatility in exchange rates began to increase. This affected many things, including making the FX markets more attractive for speculative traders. If there is no volatility, the market does not move, there is no potential for us traders to profit. The US dollar is still held today as the world's reserve currency and is used for the majority of all international trade. This may change in time, but as for when, I have no idea. So the removal of the Bretton Woods Agreement started the growth of the FX market, then followed by the rise of the machines and the exponential global trade expansion the internet has brought us. The FX markets have grown substantially year after year. Today, the Forex market is by far the biggest global financial market in the world, with some of the biggest days topping a mind-blowing massive 6 trillion in volume. Wow!